Hello and welcome to Startup Street. I'm Arundhati Ramnin, and with me as always is Shruti Mishra. But Shruti, today India's startup landscape has reached a historic milestone as the nation celebrates 10 years of the Startup India initiative, with official data revealing that over 50 new startups are now being recognized across the country every single day.
Absolutely, Arundhati. And as Startup India turns 10, we celebrate the stories that shaped India's entrepreneurial journey with CNBC-TV18's Young Turks, the OG startup storytelling platform at the helm of it for the last 23 years. And that's not all. Over the last 6 years, you've been getting your daily dose of all the startup action right here on Startup Street. So let's get on with the show. These are the top headlines from the startup space.
Quick home services startup Pink has shut down its operations, with its 3 co-founders joining rival Snabit in senior roles. Snabit also plans to hire more than 20 former Pink employees as it scales its Bengaluru operations.
Used car platform Cars24 said it aims to go for a public listing in the next 6 to 12 months as the company sees rising revenue growth in the first half of FY26. In a post on X, co-founder and CEO Vikram Chopra said the firm is on track to earn over 750 crore rupees in adjusted net revenue in the second half of FY26, recording about 35% year-on-year growth.
EdTech unicorn Unacademy plans to exit its offline business by converting company-operated centers into franchise partnerships in an internal email. Group CEO Gaurav Munjal told employees that the franchise model would allow the startup to employ an asset-light, capital-efficient business.
Prime Minister Modi celebrated Startup India movement, marking its 10th anniversary. On National Startup Day, Prime Minister Modi congratulated all the stakeholders associated with India's startup industry, adding the ecosystem that started with 4 startups in 2014 has grown to over 125 active unicorns. He added countries leading the AI race will have an advantage.
Artificial intelligence startup Anthropic has appointed former Microsoft executive Irina Chase as its managing director for India. Chose served as managing director for Microsoft's India business, a role she held for 2 years before leaving the company in December 2025.
Well, those are the headlines we've been tracking for you this evening. The top story today: the Supreme Court has delivered a landmark verdict in the Tiger Global Flipkart case, ruling that capital gains from the Walmart deal are taxable in India, potentially exposing Tiger Global to a tax bill of over 14,500 crore rupees. The ruling calls the Mauritius route treaty shopping and strongly backs India's right to tax income arising here. So what does this mean for global investors, venture capital exits, and India's promise of tax certainty? Joining me now to discuss this further are Siddharth Pai, founding partner 314 Capital, Mitesh Shah, co-founder Inflection Point Ventures, and Ajay Rotti, the founder and CEO of Tax Compass. Gentlemen, welcome to Startup Street. Siddharth, let me quickly start with you. This is being seen as a big win for tax authorities, but from a VC lens, does this ruling risk denting India's attractiveness as a long-term capital destination, or will this just mean deal structures will have to be tweaked? Siddharth, I think you're on mute. If you could unmute yourself.
The attractiveness of the Indian startup ecosystem is not actually contingent on taxation. I think it's contingent on the fact that we're a large growing economy for that matter, one of the fastest growing economies of our scale in the entire world, with a large consuming population, high level of disposable income, and a very talented pool that ends up actually existing. While tax plays an important role in the internal calculation that ends up actually underpinning investment decisions, is not the maker or breaker to end up deciding to invest in a jurisdiction or not. I think what the biggest thing of this is going to be, the takeaways from this are going to be, number one, for all the VCs and private equity funds who end up investing through Mauritius, the hygiene checks they have to do in terms of making sure there's actual substance in Mauritius, as opposed to Mauritius being just a mere conduit for that matter, is going to end up heightening. I think that's number one. Number two, also for that matter, for any of the investors who look at trying to optimize for tax, need to end up actually getting rid of that notion and end up actually working much harder to start generating higher market returns. And I think last year's IPO boom, the startup IPO boom, has shown that India can end up delivering eye-watering returns for all sorts of investors without having to resort to this sort of tax calculations also for that matter. I think number three, what's going to be most important is that the uncertainty around this entire Mauritius route has gone away. I think the Mauritius route, for all effects and purposes, is dead. and people are going to start coming to India directly as opposed to intermediate polling jurisdiction.
All right, let me go across to Mitesh now. Mitesh, do you agree with what Siddharth said? And at the angel and early stage level, are you already seeing nervousness among foreign investors, or is this being viewed as a Tiger-specific large fund issue? Do you expect more investors to now prefer direct India entities despite higher taxes simply to avoid future litigation risk?
Well, the potential for India doesn't deter at all with this. I think we are a great nation when it comes to startup growth and will continue to remain so. Taxation is a byproduct. When you make gain, you pay tax. As simple as that. And I think the Apex Court has just put that in a ruling where it amply clarifies that substance over form. So I think people will welcome this judgment. Yes, there might be some reopening of previous assessments and all.
Yes.
But at the same time, I think this will not deter any investors to not look at India purely because of the tax.
Okay.
It might open GIFT City as a big destination over in India. So I think overall, in terms of having a proper base, having an effective place of management and having substance of management in the jurisdiction where they are operating from, that's going to define the future course of
All right.
for investors.
Okay, understood. Let me get in Ajay. Ajay, the court has said that merely having a tax residency certificate is not enough. How big is this shift? There is also discussion. Is the grandfathering protection now weaker than what investors had assumed?
So, on the first bit, how big is this shift? I think this is a shift which had started a while ago. A decision like this 15 years ago would have been catastrophic because businesses were not prepared for this. And I'm saying this as a tax consultant. I've always advocated what Siddharth and Mitesh just said, which is tax has to be a byproduct, or you can't get the tail to wag the dog. The tax has to be a consequence of a commercial activity. And therefore, tax being a driver is history. I don't think we can take any decisions, including choice of jurisdiction based on tax alone, or even tax as the main factor. That is now, if there were any doubts left, the Supreme Court ruling seals that forever. I think the industry has been moving towards that. So therefore, this decision is not going to come as much as a shock as we sort of would expect. The only negative, the way I see it, is because this could unsettle some of the investors with respect to how India has been looking at tax laws. And, we had a circular which says that a TRC is enough. And therefore, certainty, which has been a big issue for us on tax litigation and tax position and how tax administration views past transaction, that will still prop up. But overall, at a principal level, I don't think the Supreme Court decision is going to change how businesses look at structures.
All right, Ajay, so could this reasoning now be applied to investors using the Singapore Treaty or other jurisdictions? How wide is the legal ripple effect?
So it is quite wide, Shruti, because, tax residency certificate or a certificate of residency, as some of the countries call it, is the basic document to establish that you are resident of a particular country. And therefore, that entitles you to a treaty. So it could be Singapore, it could be Netherlands, it could be Cyprus, it could be any of the treaties for that matter.
Okay.
The primary basis of which applying a particular treaty is the TRC. Therefore, if the tax office is not going to treat that as a conclusive evidence, then the impact could be across treaties, across transactions, not just capital gains.
Okay. Siddharth, coming back to you, do you see this verdict reopening old deals and creating uncertainty around exits that were considered settled? Would you say Mauritius or Singapore holding companies would become a thing of the past?
Oh, 100%. I think given the fact that GAR, the gentle anti-avoidance rules, have actually been applied to this as of now, everyone believed that your older investments were grandfathered and actually immune from GAR. I think everyone's now awoken to the fact that GAR ke aage jeet hai, and they have to end up actually pleading their cases now in the courts with regard to the application of GAR, which places the onus on the investor to show that they did actually have substance in Mauritius or Singapore, for that matter itself. I think for all the exits, and Ajay can actually correct me if I'm wrong, but all the exits from financial year 1920 onwards, there is a strong chance that the tax department can end up actually opening up all of them as of now, reopening assessments, and end up actually applying the lens and the razor they've gotten from this Tiger judgment against all those cases. So it is important to be well aware of that and to end up guarding against it as well.
All right, final two questions. One, Mitesh, for you, if you could quickly answer that. Founders watching this might worry about fewer global funds or tougher exit renegotiations. Does this change how founders should think about choosing investors or structuring offshore holding companies?
Well, I don't see any reason for founders to worry. One, global interest in India will continue given the value that we produce. Second, there are ample of Indian funds as well, which can look at great founders. But I think in terms of overall understanding of founders, very, very important for them to understand the VCs with their effective management as well.
Okay.
Just having a Singapore or Mauritian presence will not kind of justify now. You need to look beyond the paper and look into the substance of the management.
All right, Ajay, final words. What would your immediate advice for funds and startups be? What should they change today? And, if you're a global investor looking at India today, what's the single biggest change you must make in how you structure, invest, or exit?
I think the most important thing is if you're choosing a particular jurisdiction, then you better have a commercial rationale and a commercial decision. Let business drive tax and not the other way around. That would be the single biggest, input for structures, not just holding structures, but for even your transaction and operational structure. Let business drive tax. Therefore, if for business reason you need it to be in Singapore, then that's good enough, and therefore you'll be able to justify it. But if you want to open a holding company in Singapore, Cyprus, wherever, only because there's a tax benefit available, then you are in trouble.
All right. On that note, I'll have to wrap up our conversation. But gentlemen, Siddharth, thank you so much for your time and for joining us on Startup Street. Of course, Mitesh and Ajay, again, thank you so much for your time.
Thank you.
Thanks for having me. Thank you.
India's energy transition story is attracting serious capital. Transition VC has closed its debut fund at 700 crore rupees, nearly double of its original target as investors bet big on India's future of energy. The fund is backing engineering-led startups across electrification, storage, industrial decarbonization, and alternate fuels at a stage where conviction is scarce, but impact can be massive. So what's driving investor confidence? Where's the capital going? And how big can this platform become? I'm joined now by Rayan Shingati, the co-founder of Transition VC. Rayan, thank you so much for taking time out and being here with us on Startup Street. Fund 1 closed at nearly double the original target, right? So what sort of changed during the fundraising journey, and what did LP see in your thesis that gave them the confidence to back this particular theme in such a big way, and how big is this opportunity?
So thanks to LPs, of course, and thank you for having us. So we've successfully closed a 700 crore fund, oversubscribed from our initial target of 400 crores. I think this strong response shows the growth in conviction that India's energy transition is no longer optional. It's not about just climate change. It's about India's energy security and long-term energy independence, especially in today's volatile geopolitical environment, right? We see this as a massive $250 billion plus opportunity in India by 2030. And we are backing startups that are making real decarbonization difference while making real money. So, yeah.
Sure. Yeah, and within this broad energy transition theme, right, there's electrification, storage, alternate fuels, industrial decarbonization. Where are you sort of leaning in most aggressively today, and which areas do you believe are still sort of underappreciated?
So we invest in energy solutions that make existing solutions faster, cheaper, better, and not just science projects. So the real opportunity that we see is in industrial decarbonization, data centers, smart meters, electric mobility value chain, advanced manufacturing and green manufacturing solutions, and also long duration energy storage and power electronics, semiconductors as well. And these are exactly what we've backed from our Fund 1 so far. We also see a massive opportunity in the whole hydrogen economy coming up. And this, we believe, would be very important for India's goal to be eventually energy independent.
Sure. And how much of this Fund 1 is sort of reserved for follow-ons? And how actively do you plan to double down on breakout companies as they move from early traction to large-scale execution? Take us through the deployment plan at this point. You've already invested in a couple of companies, so take us through that plan.
So we've invested almost 60% of our capital. We've identified about 17 startups, and we believe we will invest the remaining by end of this year. So we invest something known as catalytic capital, which we believe is a major gap in the market. This is where after the product is developed, but before product market fit is established. This is a major gap today that we are filling in with our capital. We invest anywhere between 1 to 3.5 million over the life of the startups. In some cases, we invest couple million, and then we reserve another 1.5, 2 million to help them achieve product market fit at scale. We measure success very clearly, and for us, it is helping startups hit almost 100 crores of revenue, turn towards EBITDA positive within 24 months of our investments, which is slightly unconventional in VC investments because we believe in positive unit economics and not growth driven by cash burn. So with that belief, we invest a lot in hardware technology solutions, which again is quite ignored by most VCs, unlike software-driven solutions.
Sure, and you've already
That's exactly
seen...
where we see a massive hope.
Yeah, and you've already seen acquisition interest across the portfolio, right? So how are you sort of thinking about exits, strategic M&A versus IPO pathways in India's like evolving energy and manufacturing landscape?
Absolutely, and those are tough calls, right? So we've seen over 6 acquisition offers, and they're tempting because there are multiples of where we invested at. But we believe in our founders because they want to build something larger than themselves. Indian public markets has rewarded engineering companies very, very handsomely, which is why we believe providing the right resources, which is not just capital, but also deep domain expertise, which comes from our LPs to help them open up our networks, convert relationships to purchase orders, and really hit that 400 to 1,000 crores of revenue in 5 to 8 years of our investment period and drive them towards IPO. It would be good to see almost more than half of our companies move towards IPO eligibility. That doesn't mean that they'll all go IPO within our investment horizon. Some of them would be pre-IPOs or secondary exits, but about 30 to 50% of our portfolios could also be M&As, and that's purely driven by high gross margins and VC scalable businesses that our founders have built.
Sure, and with Fund 1 closing at 700 crore rupees, Fund 2 is already seeing early commitments, right? How are you sort of thinking about AUM growth over the next few years, and what does right size scale mean for a sector as capital intensive as energy transition?
This is something we've heavily debated internally, and it's a good problem to have. We've seen early commitments for Fund 2 as well, even though we have not started raising capital. We want to start raising capital before the end of this year, after we've completely deployed. We believe it should be at least a 1350 crores or a $150 million fund. And we've built a solid thesis around it. And we believe that's exactly what India needs for the next 3 years of energy transition growth. And we would be here with the capital to provide it.
All right, you will be there with the capital provided. All right, Rayan, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best going forward on this journey.
Thank you. I appreciate it.
On that note, it is time for us to head into a short break. But coming up next, AI services firm Aivar bags $4.6 million in a seed round led by Soren Investments with participation from Bessemer Venture Partners. We put the firm's founder on the hot seat to find out more. Stay tuned.
Well, on the hot seat today, we have AI services firm Aivar that has raised $4.6 million in a seed round that was led by Soren Investments with participation from Bessemer Venture Partners. Operating as an end-to-end AI studio, Aivar spans strategy consulting, custom AI solution development, and managed AI operations, and it claims to have scaled to more than 80 customers in under a year. The startup says this new funding is going to be used to expand their presence across the India, US, and the Middle East, while Well, on the hot seat today, we have AI services firm Aivar that has raised $4.6 million in a seed round that was led by Soren Investments with participation from Bessemer Venture Partners. Operating as an end-to-end AI studio, Aivar spans strategy consulting, custom AI solution development, and managed AI operations, and it claims to have scaled to more than 80 customers in under a year. The startup says this new funding is going to be used to expand their presence across the India, US, and the Middle East, while also continuing to invest in the AI accelerators, senior talent, and global delivery capabilities. For more on this, joining me now is Kaushik Rajendran, the co-founder and CEO at Aivar. Kaushik, thank you so much for your time here on Startup Street, and congratulations on that $4.6 million fundraise. Start by telling us where exactly are you going to deploy this capital, how much into talent, how much into accelerators, and how much into global expansion?
Thank you, Ritu, for covering Aivar. And see, this funding is going to unlock four things, right? First is geographical expansion. We are scaling across India, the US, Middle East, and this will help us to strengthen our India market, at the same time expand in US and Middle East meaningfully. We also have plans to scale in Singapore and Australia in later part of the year. Second, deepening our AI talent pool. We are hiring senior engineers and also delivery experts. And then thirdly, it's going to help us improve our accelerators that we have currently. When I say accelerators, these are AI solutions that can readily be deployed in customers with very minimal customization.
All right. So far, you've scaled to more than 80 customers in less than a year. What does that translate to in revenue today for you? And what kind of run rate are you exiting this financial year and say the coming year with?
Absolutely. Basically, we were able to scale fast because of three reasons, right? One is strong validation because of our initial customer traction and collaborative GTM with cloud players like AWS being their strong partners, and some of the competencies we have learned like generative AI competency. Now, these credibility opens door for us, right? And second are accelerators. We are a service-first company, but also we have accelerators, and we also operate at studio model. Now, what customer would see is an immediate traction in weeks, not like quarters or month, which would be a typical use case when you're working with an SI from traditional setup, right? And these are the factors that are helping us scale fast. And number two is we are operated at a product level margins, and also like we deliver at a much accelerated pace. So blend of all of this is scaling fast.
I was reading that you talk about delivering projects in weeks instead of months for companies. What does that do to unit economics? Do you get higher margins per engineer or just faster revenue velocity?
It's both. This helps us to basically cut short instead of using like a traditional setup of 20-30 people team with like over a year-long project to like 6 to 8 weeks kind of a delivery with a very lean team augmented by AI. So this basically helps us reduce the cost for the customers and also like improve velocity of how we deliver.
Okay, you told us at the start you have expansion planned across the US, India, and the Middle East. Which geography out of these is expected to drive the bulk of your revenue growth over the next 12 to 18 months? And which of these is the fastest growing for you?
See, interestingly, all three geos that we want to land and scale, which is India, we are already scaling quite well. And then in the US, a bulk of lots happening in the US market. So naturally, we would be investing into the US market. And third, we are also seeing significant traction and announcements in the Middle East as well, like a lot of infrastructure and also sovereign cloud being built on Middle East, where there is a need for a company like us to build solution and last mile application. Same is the case with the US being bulk of whatever AI wave is happening. So we are going to invest a lot more in the US as well.
Well, Kaushik, finally, how capital efficient is the model? I mean, with this round, how much of a runway do you get? And also, secondly, when do you expect Aivar to reduce or rather reach cash flow break even?
See, Ritu, we are already good when it comes to operating expense and everything, right? So we raise money to basically scale fast, because as a founder of this company, our fear is to basically opportunity loss, because a lot of very interesting things are happening across the globe, where this capital is going to fuel our scale across different geo and also deepen our relationship with our existing engagement, not necessarily to sustain what we're doing. So this is going to help, like I mentioned initially, to hire fast and scale meaningfully across all these regions. Because see, our vision is to help a lot of enterprises to move from isolated pilots to become operating system of enterprise workflows, right? With measurable outcome. So this capital is going to fuel that.
All right, Kaushik, we'll leave it at that. Thank you very much for joining us here today. It's been a pleasure speaking with you.
Thank you, Ritu. Bye-bye.
Okay, and on that note, we're going to wrap up this edition of Startup Street. From From all of us here, goodbye. Thank you for watching. Stay with us